Bueno, muy buenos días a todos. Bienvenidos a un nuevo martes de Mercado Global Colombiano. Hoy tenemos un súper invitado en esta charla del día de hoy. Tenemos a Rob Carey. Él nos va a hablar hoy sobre el panorama y el outlook del mercado de renta variable de Estados Unidos. Eh, Recordemos que en la Bolsa de Valores de Colombia actualmente tenemos a disposición de todos los inversionistas de mercado global colombiano un sistema de negociación para poder comprar valores, lo que son acciones y ETFs de mercados internacionales. El día de hoy vamos a tener una charla muy interesante. Nos van a hablar sobre el mercado de Estados Unidos. Primero que todo, le agradezco a First Trust por aceptar nuestra invitación. Para que todos sepamos un poco acerca de First Trust. First Trust es la sexta proveedora de ETFs más grande del mundo. Tiene más de 190 billones de activos bajo administración, una presencia en más de 27 países del mundo, incluyendo Estados Unidos, México, Brasil, Perú, Chile y Colombia. Y en Latinoamérica trabajan con instituciones que utilizan ETF para construir portafolios, especialmente exposiciones y asignaciones en la renta variable de Estados Unidos y en renta variable a nivel global. Asimismo, contarles un poco, First Trust Portfolios es líder en la industria de soluciones temáticas, multifactoriales, en investigación económica. Tienen sede en Chicago, tienen oficinas en Texas y un equipo dedicado exclusivamente también a instituciones en Latinoamérica, liderado por April Rippey. Entonces, pues bueno, hoy tenemos a Rob Carey. Él es Chief Market Strategist de First Trust. Para hablar un poco sobre Bob. Bob es CFA, él es graduado de física en la Universidad de Illinois, cuenta con más de 30 años de experiencia como analista de renta variable y renta fija, y hoy es estratega de mercados, jefe de mercados de First Trust. Básicamente Rob en su día a día, en sus labores, viaja por Estados Unidos, por Canadá, para ofrecerle a los brokers y a los inversionistas un análisis de los mercados, las tendencias actuales y lo que para él cree que pueden ser oportunidades de inversión. Él ha participado también en programas de televisión como radio, como Bloomberg Radio, televisión de Bloomberg, TV, CNBC, y también ha hecho parte de varias publicaciones en el Wall Street Journal, The Wall Street Reporter, entre otros. Entonces, pues, sin más preámbulo, le vamos a dar la bienvenida a Bob. Esta charla tiene un objetivo, Bob nos va a hablar sobre la dinámica del mercado de renta variable en Estados Unidos. Vamos a enfocar mucho en el mercado accionario, en los sectores que tenemos en este mercado accionario de Estados Unidos. Lo vamos a ligar mucho, como les decía al principio, a cómo yo como inversionista desde el mercado global colombiano de la Bolsa de Valores de Colombia puedo acceder y puedo tener exposición a este mercado americano. Entonces, esta charla la vamos a dar en inglés para todos. Eh, Al final vamos a tener una sección de preguntas, entonces todos los que estén interesados pueden irnos escribiendo a través de YouTube y las diferentes redes, las preguntas que tengan, y al final pues yo con mucho gusto se las voy a transmitir a Bob para que nos las responda. Entonces voy a cambiar a inglés. Welcome Bob. First of all, thank you very much for accepting our invitation to this event.
Good morning, Nicholas. Great to be with you.
Okay, thank you, Bob. Bob, the main objective is if you can share with us your general outlook of the U.S. equity market and some useful context of the main sectors of the U.S. market. Only for your context, Bob, here at the Colombian Stock Exchange, we have a foreign securities trading system that allows any investor to buy foreign securities, can be stocks or ETFs, through a local broker and under local trading rules. So it is like a trading system very similar to the SIC in Mexico. So currently, we have listed here in the Mercado Global Colombiano some stocks, some shares of the companies that are listed in NYSE, in NASDAQ. For example, some names we have here: Apple, Amazon, Bank of America, JP Morgan, Pfizer, Johnson & Johnson, Ford, Uber. There are some names. And also we have some ETFs with exposure to the S&P 500 and some ETFs that are have exposure to some sectors of energy, technology, healthcare, robotics, among others. So, okay, Bob, so you can start now. At the end of the session, we will have some questions from the audience. So thank you very much for the space.
Great to be with you, Nicholas. It's wonderful that we have so many opportunities globally today to make investments in places and in ways that we could never have imagined a generation ago. It really is incredible. There's no doubt that we have been through a lot of challenging things to deal with, events certainly the last couple of days, if not the last several years. On top of that, obviously we had a global pandemic in 2020 and 21, and I would submit that we are still dealing with the after effects of the pandemic. One byproduct of the pandemic is that we saw massive fiscal stimulus. A lot of cash, a lot of money was created back in 2020 and 21 to essentially help the economy from a short-term perspective. And all that money was created. And a lot of that money ended up, of course, being deposited at banks, and financial institutions all around the world had a surge of deposits, the likes of which we have never seen in such a short period of time. And there's no doubt that a lot of that cash was invested. A lot of it was lent out, of course, that's what banks do. But when banks don't make loans, they typically buy investment securities, they buy bonds, they buy treasury notes, they buy all kinds of different investments in the marketplace. And the recent news, the failure of several major regional banks, local banks in the U.S., is nothing more than a mismatch of basically liabilities and assets. A lot of those investments were invested in very, very low interest rate instruments, treasury notes, treasury bonds, in particular, mortgage-backed securities. And obviously, we've seen a sharp increase in interest rates in the last couple of years. And there's no doubt that we have quality assets, but when they are priced where they are being priced, there's no doubt that has taken a rather significant toll on the balance sheets of many financial institutions in the U.S., and not just the U.S., financial institutions all around the world. And really the news over the last couple of days, the failure of Silicon Valley Bank in particular, was not the result of bad loans and the bank essentially running out of money because the people they lent to were not able to repay the loans. That's the usual situation in a bank failure. This was just simply a bank needing capital, and they were not able to raise capital in enough time to meet a very, very significant amount of withdrawals. They saw basically 30 to 35% of their deposits were basically called upon very, very quickly. So a very, very unusual situation. I've been a securities analyst going on 38 years, and I've never seen a bank fail in this kind of circumstance. Very, very unique set of circumstances behind this failure. And I do think at the end of the day that the depositors will be made whole. And I think we're having a very serious discussion in the U.S. here about the safety of depositors and banks, and who's liable and where all this comes down. But I think ultimately Silicon Valley was very, very successful. A lot of companies obviously have been started there, are continuing to be created there. The whole world couldn't wait to put money in that bank. And those companies were very, very flush during the pandemic years. And the end result is that a lot of, you think about how low interest rates were a couple of years ago, it had a very significant impact. This is another way of looking at it. The interest rates, this is the yield on the 10-year Treasury. We had yields all the way down to 0.5% on the 10-year Treasury back in 2020. And that rate went up a little bit to about 1% in 2021. Well, today it's around 4%. It's been as low as 3.5% the last couple of days. But when you buy something with a long-term duration with interest rates this low, and now prevailing rates have increased, it's going to have an effect on the price of those assets. And anyhow, we've been through a lot of different things. I want to spend a couple of minutes talking about the U.S. stock market. And there's no doubt that we have been through a very interesting shift here in the last several years. We had this incredibly narrow market from 2017 until 2021, where essentially when we look at the S&P 500, we saw that most companies in the S&P 500 were actually not keeping up with market averages. The average stock actually did not perform as well as the stock market. And what that means basically is that the market, the S&P 500, was driven largely by the bigger companies in the index. You would see quite often investors buying just a handful of companies that dominated the market averages, and the average stock actually didn't do all that well. It's really kind of an echo, if you will, of what happened back in the 1990s. The second half of the 1990s, we had a very similar environment, a lot of interest in, of course, technology companies at that time. A lot of the internet-related companies, .com companies, were very, very popular. We saw a rather significant correction, even a bear market in those stocks. And in the years after that, we saw the average stock actually do pretty well. I think last year was the beginning of something that I think will play out much the same way. Obviously, we had a bear market last year. Whether or not we're still in it, we're about to go into another bull market. We are not really in that camp. We think it's going to be a little while before we really see that all systems are go. But I think along the way, I think most investors would benefit from having a little bit more exposure to stocks outside of just the very biggest companies. There's nothing wrong with having weightings in those areas, but I think the average company, I think, is probably better priced than the biggest stocks in the market average. So last year was the first year in quite a while. We've actually seen a slight uptick in investor allocation into small and mid-cap stocks. This is something that's we've been waiting for quite a while. You can see that really for the last decade or so, almost 15 years, the average investor really did not have much exposure, less and less exposure to small and mid-cap stocks. So we have not seen small and mid-cap stocks weighted this way since 2000, so the year 2000. So a lot of investors, I think, have been playing it very, very safely, very conservatively. They've tended to prefer large companies as opposed to small companies. And I think that might start to shift over the next couple of years as well. From a stock market perspective, there's no doubt that valuations on the equity side are more attractive right now, even after the rather sizable increase in yields over the last couple of years. We do think that the S&P 500 is better priced than say buying treasuries. Obviously, those rates are significantly higher, as you can see, compared to where they were a couple of years ago. But right now, the S&P 500 has an earnings yield, if you will. This is not the actual yield. This is basically the yield if all the companies in the S&P 500 were to pay out all of their earnings in the form of a dividend. The dividend yield right now, the earnings yield, is about 5.5%. Obviously, that's better than 3.5% for the treasuries. You can see these two lines are very, very highly correlated. So a lot of what we've been through, both going into COVID and then coming out of COVID, a lot of the valuation, a lot of the changes in the market, the S&P 500, in fact, have been driven by what's been happening in the bond market. And that's really not unusual. If you go back to the 1990s and the 80s, even the 70s and 60s, you go back through the decades, usually these two measures of yield and earnings yield typically track each other very, very well. In fact, for many years, they sat right on top of each other. They're almost exactly the same. And then we got to a period of time from about 1998 or so up until 2014, really about 15 years, where these two lines actually went in opposite directions. Very, very unusual. But you think about all the things that we went through, the dot-com meltdown, the great financial crisis. We had a lot of things happen during that time, and investors were constantly going back and forth between stocks and bonds. It was risk on, risk off, risk on, risk on. We are now beginning to see these two measures begin to sync up. And I think at some point we will see these two lines once again begin to, in fact, converge, and they might sit right on top of each other. And right now, I would submit that the earnings yield of the S&P is a very, very powerful force for the market. However, this year, for the first time in a very, very long time, outside of the year of the pandemic, if you will, in 2020, it looks like earnings are going to come down a little bit this year for the S&P 500. We do think, and we believe very strongly, that over long periods of time, the direction of the stock market is very much driven by profitability. And you can see that the companies in the S&P 500 are substantially more profitable today than they were 15 years ago. And obviously, I start here in 2009. I could have taken this back to any year pretty much, and you can see the profitability has improved quite a bit. We had a record year of profitability last year, and the market was down. And as I showed you earlier, a lot of what we saw last year was interest rate driven as opposed to earnings driven. This year, we might start to see rates become less of an issue if, in fact, we start to see inflation coming down. So far, that hasn't happened yet. We got an inflation number today. It was maybe a little bit better than expected, but we still have inflation running at 6% year over year in the U.S. That is unacceptably high, and I do expect that even with the issues that surrounding some of the banks, I think the Fed will probably raise interest rates again. Maybe not this month like we were expecting, but I think it's very likely the Fed will nudge rates a little bit higher here as the year goes on. So we're watching earnings estimates very, very closely. We are literally one company away from closing out the books on 2022. So this chart will change a little bit here in the next couple of days, but we do think that profitability is going to be a challenge for the S&P 500 this year. The situation outside the U.S., when we look at companies from a global perspective, it looks like we are going to have a modest increase in profitability from a dollar perspective for companies outside the U.S. But if you look at the trend over a long period of time, you'll notice that profits really haven't gone up very much when you look at markets overseas. This is really, I think, the main reason that the stock market in the U.S. has been such a strong performer. This orange line is just simply the relative strength of the S&P versus the rest of the world. This has been a very, very U.S.-centric stock market increasingly over the last 10, 12, 13 years. And that, I think, is really no more complicated than the fact, just taking you back, this is a much more impressive looking line than this. This is a very, 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 very slow line. I think really what's going on is that companies in the S&P 500 generate much higher rates of return on capital. The ROI at the balance sheet level for the S&P 500 right now is close to 9%. When we run that same calculation for companies outside the U.S., that rate of return is closer to 5%. So a very significant difference in terms of how much returns companies generate on their balance sheet. U.S. companies have really, I think, because of technology, the emergence of technology companies, and then, of course, companies utilizing technology, I think that has been a real game changer. Now, the dollar in the past, when we look at this chart, we see the U.S. outperforming. We see the U.S. underperforming, maybe outperforming. All of it was really driven by currency. If the U.S. dollar was strengthening, of course, you wanted to be in U.S. dollar, be in the S&P 500. If the dollar was declining, like it wasn't through here, you wanted to be in non-U.S. stocks. And that relationship held up very, very well up until recently. But the dollar has been, I would submit, fairly range bound. And yet this outperformance has continued. Now you can see that the dollar has cooled off a little bit compared to where it was a little while ago. I do expect the dollar to, as long as interest rates remain elevated and the Fed is positioning itself to raise interest rates, I do think the dollar will stay relatively high. But I think the dollar is going to be largely range bound here over the next couple of years, whether it's against the Colombian peso, or really any other measure of the US dollar, the correlations are very, very high between the dollar and other currencies around the world. So US companies, generally speaking, have higher rates of return on capital. Now, with that, I want to spend a couple minutes talking about sectors. Sectors are important. We've been doing sector-based investments at First Trust now for going over 30 years. This is something we've been very, very focused on. And my way of analyzing and breaking down the S&P 500 from a sector standpoint is I simply look at the trends in profitability. I'm looking backwards a little bit, but also looking ahead at earnings estimates, and I'm calculating the trend in profitability. Now, this is utilizing earnings estimates for this year, but I'm looking back over the last 2 years at profitability, and I've got 3 data points. I can calculate the trend, and then at the same time, I'm comparing those trends to valuations. And what I find interesting is, as a strategist, what I'm really looking for are outliers. I'm looking for areas where maybe the blue is relatively high compared to the orange. From an investment perspective, that's what I want to see. I left energy off of this charts, and the reason I did is that it literally is off the charts. As the companies in the energy sector were unprofitable in 2021. Obviously, they were more profitable last year. Profits are expected to be down a little bit this year. It's very hard to calculate the trend, but energy very much falls into this category. If you look at sectors such as financials, industrials, materials in particular, those are all sectors that are cyclical in nature. They are sensitive to the economy. They have economic sensitivity, even though profitability is trending in the right direction. Investors at this point are basically pricing these companies to be less profitable over the next couple of years. Valuations are relatively low from that perspective. We're getting a lot of questions right now about just how much is the stock market discounting a recession. And when I see the blue at these levels compared to the orange, it tells me that the market is bracing for a slowdown in profitability in an economy. Conversely, sectors that are more defensive, non-cyclical sectors, the 3 big ones, really the 4 big ones, consumer staples, healthcare, communication services, and utilities, you'll notice that in each case, they have the exact opposite looking metrics. The numbers are different for those sectors that are defensive. Investors are more than happy to pay up for earnings growth rates that are relatively low. Perhaps the most attractive of the 4 is the healthcare sector. This is a sector that has a little bit better, and I would say maybe communication services. Those are probably the 2 areas. Most investors, when they get defensive, they tend to buy staples and they tend to buy utilities. I think investors are better off buying healthcare and owning communication services if they are trying to play defense from this perspective. Now, the tech sector, valuations have come way down in the technology area as well as the consumer discretionary area. Those are 2 sectors that have some rather high PE stocks. And quite often what we do when you look at those sectors is if you take out maybe the top 4 or 5, 6 names out of the index, and you'll find that the average stock has a very, very low PE. For example, the consumer discretionary sector, Amazon and Tesla are the 2 biggest companies in the consumer discretionary area. So if you take those out, valuations look a little bit better. In fact, they look a lot better from an index perspective. Growth rates are a little bit lower as well, conversely, not surprisingly. But I think right now the market is, I think, doing a pretty good job of pricing in a recession at this point when we get down to the sector level. If we go a little deeper into investment styles, using the same framework right now, we see that the large cap growth area of the market has maybe the least attractive looking style box. If investors are willing to go a little deeper into mid caps and in small caps, I think there's a real opportunity in this particular part of the marketplace. It's not really an area of the market. It certainly shouldn't be a core part of investor portfolios, but I think the opportunity is there. I think that we are looking at returns. When I look at the value side of the market versus growth, I don't see necessarily a huge difference between these two areas of the market. I think investors are going to do about the same over the next couple of years between growth and value. I think earnings will eventually start to rebound. We look at the 2024 earnings estimates, even though they've come down, I think the comparisons will get much, much easier. So I think it's pretty safe to say that near term, over the next 6 to 12 months, our expectations are fairly modest at this point. But at the same time, when we look a little bit further into the future, I think you're going to see better returns from a long-term perspective. I'm going to share just one last thing with you, Nicholas. This ties into something that I think investors really need to think about from a long-term perspective. I turned 60 in a couple of months, and I'm going to a lot of birthday parties right now with my fellow people turning 60, right? So a lot of people my age. I'm at the end of the baby boom in the US, and I'm buying birthday cards. And you go to buy birthday cards these days, at the bottom of the shelf, a lot of birthday cards for people turning 60. They got birthday cards for people turning 70, 80, even 90. I've noticed over the last couple of years that you can buy birthday cards now for people turning 100 years old. This is something that I didn't see, and we wouldn't have seen 20 years ago, 30 years, 40 years ago. But I think it's pretty fair to say that life expectancy has increased rather substantially. And I think at the same time, investors increasingly need to think about long-term investments. And obviously there's a lot of volatility that comes with being an equity investor, but as you can see, as more and more money is created, the stock market usually follows right along with it. For every dollar that is in circulation or was in circulation 50 years ago, let's go back to 1973, for every dollar that was in circulation 50 years ago, there is now $26 in circulation. And that's just the US. Obviously, you can take that same sort of analysis of the money supply and apply it to really any place in the world. And there's almost really nowhere, in fact, there is nowhere where we haven't seen an increase in the money supply. That is, from a long-term perspective, it's inflationary. And as you can see, the companies in the S&P 500 have increased in price as more money is in fact in circulation. So a lot of this ties in. I think ultimately the companies that make up the market, we think of ourselves as investors, but really what we're betting on and what we're investing on from a long-term perspective is the ability of companies in the marketplace to do a good job of making investments, and that's really what it's all about. As I mentioned earlier, the S&P 500 right now and we have seen a rather remarkable transition here in the last 20 to 30 years. From that perspective, we have a rate of return today, as I mentioned before, it's about 9% for companies in the S&P 500. You go back a generation ago, and that rate of return was around 6%. Companies have become more and more efficient. More and more companies utilize technology. More technology companies have come of age. So a lot of very exciting things. And in spite of all the headlines that we see over the last couple of years, I think fundamentally, I think companies remain well positioned to be good long-term investments. So with that, I will stop right there. Nicholas, I'm more than happy to answer any questions that you may have and anybody else may have. So let me turn this back over to you.
Okay, Bob, thank you. Very interesting. All of you are telling us. Yes, we have here several questions from the public. Maybe I'm going to ask you a few questions to clarify some points of your presentations. For example, here, someone is asking, which US sectors do you see as undervalued or overvalued? And in which do you think there is some prospect of growth or valuation by 2023?
Yeah, right now, the sector that has the most undervalued parts of it right now actually is the energy sector. I've left energy off this sector chart because the blue is so high, it would make the chart unreadable. But I think that for the most part, I think there's an opportunity in in a lot of different areas of the market. Really about the only place that I am worried about valuations right now would be the utility sector as well as the consumer staples. These two sectors, when you take a look at these blue lines, they're very, very low relative to the orange. Valuations are extended. I'm able to find plenty of good long-term, reasonably priced, even undervalued companies in most other areas of the marketplace. I think these are, I think the only two areas where I would be very cautious about having too much exposure to right now from a sector standpoint. I think if you have to be defensive or you like the idea of buying something that is not economically sensitive, I think the healthcare sector is the most attractive place in the marketplace. The pharmaceutical companies, the biotech companies, I think there's opportunities in that particular area of the market. We've had a very slow couple of years as far as mergers in the pharmaceutical and biotech space. We got news the other day of a very, very large acquisition between a large pharmaceutical company and an up and coming biotechnology company. I think that's a sign that we are going to start to see more merger activity. So investors have been shying away from biotech, and I think biotech in particular in healthcare. I think there's an opportunity there, certainly from a long-term perspective. And at the same time, you really don't have to worry about the economy overall. But I think that, as I said before, I can find plenty of companies in the industrial space, materials, even infotech. Infotech valuations have come way down recently compared to where they normally are. So I think there's plenty of opportunities. I would just be a little bit careful about overpaying for some of these safer companies. Safe assets in general, I don't care whether it's safe treasuries and safe investments like that or safe sectors in the stock market. Investors are paying a lot for safety right now. And you can understand it given the headlines, but I think investors have probably overdone it here recently.
Okay, Bob. Also here we have another question, maybe of the financial sector. They say,
Yeah.
Considering the events of the last week with the Silicon Valley Bank, what is your perspective regarding the US financial sector?
I think that we need inflation to come down. I think really the biggest problem that the financial sector has right now is not credit related. Loans are the banks are well capitalized. The default rate is quite low. I think the biggest problem the banks have right now is that the yield curve is inverted. In other words, deposit rates and short-term interest rates are higher than interest rates on longer-term loans and on longer-term treasuries and treasury bonds and the like. At some point, from a long-term perspective, you're not going to see profitability hold up very well. Banks are in the business of making loans and generating a spread between their interest costs and what they earn on those loans. And right now, net interest margins are under a lot of pressure. And it's a sector of the market where I think there are certain companies that are well priced. And certainly after the correction we've had, I think there's some opportunities. But I'm a little bit cautious about going too crazy into that sector. I think that we still have some issues out there. Some banks are probably going to need to raise capital levels to offset their losses they have from a market securities that are held in their balance sheets. But I think longer term they're fine. This is not another 2008 situation. That's probably the most important thing that I can't stress enough is that this is not 2008, 2009, where we have all kinds of loans that went on a small segment of the economy. I think banks, generally speaking, are in a much better place right now from that perspective. Will they, especially some of these regional banks, will they need more capital? I believe they will. And I wouldn't be surprised if we start to see perhaps some merger activity here going forward. I would not be surprised to see maybe even some of the rules regarding just how big some of these banks can be. I think some of them should be given the ability to increase their deposit base and make acquisitions. And I think that's where we're going to go. I think that's every time we go through any kind of a crisis like this, where we lose a bank here or there, it seems to me that we end up with a little bit of consolidation and merger activity in the aftermath of that. I think we'll see that here in the next couple of years. But we've been telling the big banks over the last decade or so that they can only get to be a certain size. And I think there's going to be some increased regulations, maybe from a capital perspective, but I think those banks are going to be given the ability to maybe increase their footprints a little bit. And as Silicon Valley Bank goes away, I think there are going to be plenty of other financial institutions that are going to step right in and provide services for that particular marketplace. So it's there's plenty of capital, and I think we'll see the situation get resolved here relatively soon. But that being said, the yield curve is inverted, and I think as long as that's the case, I think financials from a near-term perspective, I don't know that I would buy too many banks right now. I think it's something that we can talk about maybe later in the year.
Okay, Bob, very interesting. We have another two questions. Maybe I will take this one. In your experience, which are the most traded stocks by the retail investors in the U.S. market, or in which sectors they are investing right now?
Great question. I would say that investors over the last, say, 3, 5, 10 years, I think a lot of them have really been very attracted to the technology sector, and for good reason. You think about some of these big names like Apple and Microsoft and Tesla. These are very unique companies. They're very, very profitable. They've been very, very good investments, high return investments. Really, about the only the issue that investors have had in some of these sectors has been valuations. Valuations have been very, very stretched for some of these companies. When interest rates were as low as they were a couple of years ago, you could justify paying a higher price for some of these companies. But now that rates have gone up, we've gone through a rather substantial correction. They're better priced. That is an area of the market that really is the biggest sector in the market, the technology sector. I think it will remain the biggest sector in the S&P 500 for a very, very long time. That being said, I think there are other areas that I think investors need to focus on as well. But I think that in general, just taking a step back, I've been in this industry now for almost 38 years. Investors, unfortunately, the individual investor over the years, they tend to get attracted to certain segments of the market. There are certain things that become very, very popular. And I think the key thing from an investment perspective is not chasing things that become too popular, where valuations get extended. I think being a long-term investor, having some discipline, realizing that the market is going to fluctuate, I think all of those lessons have been learned. We learned those lessons back in the 1970s into the 1980s. We had a period of time here, as you can see, from the late 90s up until say 2010, 2011, the market didn't do anything for a long time. Investors were very enthusiastic about stocks back in 1999. They were fairly enthusiastic in 2007. They were very enthusiastic. After we go through these corrections, as you can see, this is when you want to buy these things. Basically, that's where you tend to have the most upside, is when we've gone through a bear market. And I think that the same dynamic will play out in the future as well.
Okay, Bob. Here we have another question. Maybe if you can answer it. What about crypto market and Bitcoin as investment alternative?
Yeah, I don't really think of them as investments. I think they're still more speculative. They are a store of value. There's no doubt people are using them as a store of value, but with the volatility, I don't know that I would view them really as currency. They just don't have the same store of value that a hard currency would have, for example. That being said, the fact, as you can see from this slide, the money supply in the last several years, I think that ultimately this huge increase in the money supply in dollars, we see the same thing in euros, we see it in pesos, everywhere. The money supply increase that we've seen over the last several years really, to me, was the reason that investors and speculators really were looking for an alternative. When you see this kind of increase in the money supply, I think it's perfectly natural for investors to start to speculate maybe on commodities. In the past, I think a lot of commodity speculation has spilled over into the crypto area. But I think ultimately it's hard to price these things. I can't really say for sure what the direction of any of these things might be from a near term or a long term perspective. It's really I think as much as anything, it's a proxy for the market's confidence in inflation, getting inflation under control from a long term perspective. So will we see digital currencies going forward? I believe so. And I think that that's the one byproduct of Bitcoin and other cryptocurrencies is that central banks around the world are scrambling to come up with things that are that function in a similar manner. And I think that's going to be more the reality. I think that will be the probably the strongest byproduct of the creation of cryptocurrencies is that we will see digital currencies more and more going forward.
Okay, Bob, thank you.
Great question.
Yeah.
I wish I knew.
Yes. We are running out of time, but maybe we can have the last question here. What are your perspectives on the behavior of the Colombian peso against the performance of the dollar?
Yeah, the peso is very, very correlated. Let me take you back here to this chart. If we look at the US dollar index, this is the DXY index. It's very, very highly correlated, the peso. As the dollar has strengthened in general over the last 5, 10, 15 years against most other currencies, it's also strengthened against the peso. That trend, I think, is very much intact. I think the dollar will continue to be gradually stronger, I believe, over long term compared to the peso for a variety of reasons. But I think that there's the correlation is going to remain very, very high between the dollar index and the peso long term.
Okay, Bob. I think you have answered the main questions from the audience. Again, we thank you very much for your time and your participation. We look forward to having you back soon. So thank you very much, Bob.
It's been a pleasure, Nicholas. Good visiting with you. Thank you.
Thank you, Bob. Bueno, a todos los participantes les damos las gracias por estar acá presentes en esta charla que nos hizo Bob Carey de First Trust sobre el outlook del mercado de Estados Unidos, toda la renta variable y el mercado accionario de Estados Unidos. Vamos a tener esta presentación en YouTube para aquellos que de pronto no se pudieron conectar a esta hora, van a tenerla activa para que la puedan ver a lo largo del día. Entonces, pues, nuevamente muchas gracias a todos y nos vemos en el próximo martes de Mercado Global Colombiano. Que estén muy bien.